There is a time when you buy equities, you would be disproportionately rewarded. But there are times when you invest into equities, your future returns will get compromised. Are we in that phase for next 3 years where every equity investor now needs to take a hard look at their asset allocation toward equities and say, okay, it's been good last 2 or 3 years. It's time for me to check my equity allocation. Maybe 15, if not 15, at least 10% should be moved into fixed income instruments.
It entirely depends on how experienced that investor is. If that investor came 3 years ago, it will be very difficult for anybody to persuade him to move to fixed income because he has just been used to a different kind of market. Wherever anybody invested, one has made money. Not only that, last 3 years, 3-4 years, I don't think at any point in the last 3-4 years we haven't had this discussion that market looks expensive, looks risky, market looks dangerous. One should be a little more conservative, cautious. But I would say that given that we are getting into another kind of liquidity from interest rate cuts elsewhere, I think things have turned around. Market might remain expensive. I don't think it is time to cut short, but every investor, anybody who has accumulated something meaningful, must have fixed income at all times, irrespective of the state of the market. Good times, you should be in fixed income simply because you are able to take something off the table, whether that be 25%, 20%, 35%, or 50% is entirely up to you. That is a rebalancing reset. But timing it perfectly is impossible, as Manish was saying just now. And but so you decide on your allocation, reset it. But there are a few things which one should do. Yeah, one is that one should keep away from some of the things which apparently looks very risky. The sector and the thematic funds, and buying at any price. And we have a large segment of the market which might look very difficult. So, investors were not keen on the value theme as such. So, that could be another thing which one should be, they are keeping away from the very, hot segment of the market. So, becoming a little conservative, having a fixed income allocation, that should be the principle at all times. At this point, I think it is all the more important, but expecting that the market will correct or unless we have something extraordinary happening, I really wonder that we will have, because the earnings momentum, the tactical positioning of India, and now this flow coming in. I think it's not only difficult, but I think it is unreasonable to expect that something will actually bring down the market. And keeping aside what is the domestic flow coming from domestic investors.
Bond investors are giving us data which is that last 3-year returns in equity markets, and we are referring to Nifty here, Dhirendra. I'm not even getting into small cap and mid cap. They're higher than historical averages. In bond market, returns are in and around historical averages. If one has to really look at historical returns as a benchmark for future returns, which is what it is, because all asset classes, they follow a cycle, then equity market returns in the next 3 to 5 years should be below historical averages or should be below subpar. Is that a very basic allocation strategy which one should look at? There are times in the market, I mean, there are seasons for everything. And when weather changes, your strategy should change. Do you think the weather could change enough for equity investor?
There are plus and minuses for both part of it. The weather is changing. Fixed income might become a little more attractive. But at the same time, not to say that, the equity complexion is changing. If you look at the supply side, the number of companies which are added to the market, the kind of thing happening in the equity market, in the underlying businesses, the earnings momentum. I think the real thing is that, will our companies sustain the earnings momentum? Will they able to accelerate? Or will there be a calamity? Is it all, up in the air? Is it really, lacking substance? That I think, I'm very positive about. This particular historical context, I founded Value Research in 1990, and till 2002, 1992, the market touched a high of 4,000 points. And it took 10 years for the market to regain that level. Next 10 years, 1992 to 2002, market attained, 4,000 points on the Sensex. History doesn't, yeah, history rhymes, but it is, if you just keep track of that, that way, that was the time it took 4 or 5 years for people to really understand that market also goes up. It just doesn't go up and down. Things change.
Market according to you, and we are talking about not the FNO trader here, we are not talking about individual HNI investors. This is pure play mutual fund investor. Where do you think in the mutual fund categories or subcategories excesses are getting created? Are these in sector funds? Are these in small cap funds? I mean, I was looking at Nippon small cap fund. The fund is now managing 12-13 billion dollars. That's larger than lot of large cap schemes.
Yes, but it is not to forget that the 20, we should also look at the 20-year return. In fact, the India story will be small cap universe. And if that, and not to forget that, this is a large fund, but one should also not forget that this is a portfolio spread over 270 stocks, little over 270 stocks. This is a stock, and this is a universe of stock in which, there'll be about 40, 50 stock, which are compelling stories. And the fund manager has been able to demonstrate it with his selection and holding it for 5 year, 7 year, 10 year. When I was looking at the average holding of many of these positions, I find it remarkable. So you can say that, there might be excesses, and there has been a long period in which this fund has struggled. In fact, most of the great returns that we see is actually a compensation for sticking through a plan and not getting distracted for, sticking through a plan in lean times and holding a position over, and that is not a small period. That's not a brief period. It is 4 years, 5 years, 7 years, and that was also a period when the fund investors were losing patience. I was provoking investors that it's more than enough. Just get rid of this fund. It has tested our patience, and so despite that, the fund has been able to navigate all that period. So there might be excesses. I think, some excesses getting created in all portfolio because it is getting very difficult for people to ignore it. Fund managers, funds on a continuous basis are so based on relative performance. And it is impossible for fund managers to keep away from a segment of stock which is doing exceptionally well. But particularly, if I have to really name some of the new thematic and sectoral funds, which is attracting a lot of money, that might be, there might be excesses there, which is very concentrated.
Okay, Dhirendra, hi, morning. It's been a while that we've interacted, but I wanted to understand what your advice is when it comes to new entrants in the markets that have come into the equity class and have not come into the debt segment as yet. What do you believe is a USP here, or what would be the advice to some of these new entrants?
Yeah, I've been telling investors, but nobody has followed me, I always encourage people to start with an aggressive hybrid fund simply because, we have most investors are getting attracted to the market just looking at the upside. And they may not be completely ready for, or they may not be ready for the intermittent big declines on an ongoing basis. And this is where these funds come into play very nicely, simply because, they are a steady take on growth. They will not give you the heartburn, which might look imminent at any point. And it will happen in the next 3, 4, 5 years. There'll be at least 10 occasions when the market will fall so sharply. That will scare most of the new entrants. So start with that. Else, make sure that you are immediately after investing, you are not looking at the NAVs on a day-to-day basis. And I would also like to give you one context. If any investor has invested in a small cap fund by way of SIP over any 3 to 5 year period, one has beaten fixed income by a handsome margin.
In this conversation, we cannot perhaps have a standard advice for everyone. Just like one shoe does not fit all, everyone has a time horizon, risk, capital, gold, and the requirement of the funds. So we cannot standardize it. So I'll just stick to very broad themes. Broad mega trends. Mega trend number one is SIP. And I'm assuming that for somebody who's starting SIP, they at least have a 5 to 7 year time frame in mind. Otherwise, it's not a SIP. Then it is more like a trade here or there. For someone who's a genuine SIP investor, can think in terms of not months and quarters, but in terms of years, and has a 5-year plus time horizon, and if the starting point is today, should one still stick to SIP investing in equities?
Absolutely. SIP, most people think that, it is for return only. It is not that. SIP has, the convenience of SIP, the cyclicality of SIP, the potential of SIP that it does not really scare you. You sometimes, when the market falls, most long-term SIP investors feel happy that they are able to buy cheap. Not only that, for its simplicity and practical context, utility, that you earn every month, you pay your EMIs every month, and you save every month. You don't, otherwise, historically, what has been happening is that, you're saving in your bank account, and, at 1.1, we have 5 lakh rupees, 1 lakh rupees, then you think of investing. Here you are able to average it, and it has become convenient. The money moves out of your bank account. And, so also, we are talking about, large SIP, the growth of SIP. But when you look at it in the context of the Indian middle class and all the number of iPhones sold and the number of, 20,000 plus smartphones sold in this country, or, all other kind of spending that we get to know about, SIP is virtually in its state of infancy. And that too also has been perceived differently. Everybody has just, tried it out, tested it, it's just kicking the tires. I think we're in very early stages. And if this continues, I think there will be a problem in terms of, having the supply side, because the relative scale of the market or the liquidity in the market or the breadth of the market is not good enough to absorb. And, there is a problem in terms of the depth of the market to be able to absorb sustained rise, because it's just not SIP, it is also the NPS money. It is also if you look at another side, it's almost like 1/4 of the SIP money is coming by way of private sector and NPS. And that NPS is not 15% to equity. It is 75% into equity, and that too into only, top 200 stocks. So that is something which has not been noticed by investors or not being talked about, because it does not come in large number by individual checks. It just comes by way of the employers remitting the money from the deduction month after month, and the growth rate of that is phenomenal. That has gone unnoticed.
Dhirendra, let's close it with one actionable advice, which is that, let's say if you decided to change asset allocation during euphoric times, which is 2000, when TMT bull run was crazy, 2007, 2008, when this entire so-called old economy infrastructure boom was at play, you were rewarded with your prudent choice of making some shifts here and there. For somebody who's got a large asset allocation to equities, which purely has become large because of the appreciation, is it time to rein in, or is it time to continue to ride on?
I think it is time to rein in. And because last 3-4 years have been so extraordinary that everybody, just came on board post-COVID, and then have been in a state of market and mind that, you have missed the bus and you should not exit. Think of asset allocation if you don't have one. Make sure that you are, and if you don't have asset allocation, you will not get an opportunity to rebalance. You will only watch it go up and down. And, the first time investors who have come in the market in the last 4 or 5 years, they will be greatly disappointed because they have not seen any blow so far. So if you have no fixed income, have 20%. If you have some fixed income, make sure that it is 33%, and you are actively, keeping track of it. And rebalance it. Define your rebalancing rule that, if there is a shift of more than 8%, I will rebalance. Don't do it on every change, but do that. And, if you are able to frame that rule, document it, keep it on the tagboard to remind you all on an ongoing basis, I think that will enhance your return, and you'll be able to capitalize on all the intermittent opportunity that comes your way.
All right, Dhirendra, good having you on board. Thanks so much for giving us that perspective as we discussed investing the debt way versus equity and what investors should make of it.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.